We are watching shares of Apple today down at the moment before the bell. Now, the company posted record quarterly sales and better than expected guidance. However, investors are concerned about rising memory prices. Our next guest says Apple's results show consumer spending is holding up surprisingly well. Joining us now is Lorne Steinberg, president at Lorne Steinberg Wealth Management. It's good to have you in studio.
Great
Thanks
to be
for
here.
coming
Thank
in.
you so much.
So you say consumer spending holding up well, despite what's interesting with these Apple results is the fact that there is going to be higher prices coming soon. I'm not sure if
Sure. And first of all, one of the interesting things is the average selling price was up significantly, which tells you that consumers are still able to keep on spending and buying more expensive iPhones. And that augurs, it's really a sign that consumer spending is pretty strong. And the Fed statement the other day also indicated that they're seeing a healthy consumer. Unemployment is relatively stable. So we're pretty bullish on those statistics.
You say it's surprising, though, right, that consumer spending is still strong, despite what we're going through right now. Why do you feel like it's so surprising?
I think it's something surprising given some of the negative news we're seeing. We're seeing softness in the auto sector and some other large manufacturing areas. Employment growth has been, somewhat weak. Unemployment up somewhat. Those are usually times when you see consumers pulling back somewhat, but we're seeing really healthy earnings from the consumer products and related companies.
Is there any other big earnings takeaways from Apple? I know Visa reported as well yesterday. Is there anything that stands out to you in terms of what you're talking about, like consumer spending?
Sure, a couple of things. And American Express reported this morning as well. And I'll tell you, one of the big things that we see there is that card spending is up in general, 8 or 9%. But also that bad debts have not risen very much. So the fact, usually bad debt increases is a sign that things are going to be softening. But to see big increases in card spending, both from Visa and from American Express, as well as strong earnings from companies like Apple and even Starbucks, is an indication that consumers are in a pretty good place.
We've seen, of course, rates both here in Canada and in the U.S. expected to hold steady, at least for a little longer. How does that factor into consumer spending, do you think, particularly with the Fed?
Well, I think the bigger indication is that the Fed not cutting rates because they're concerned from the other point of view that consumer spending is going to remain rather healthy and economic activity will be relatively robust, is an indication that, they see the data before anyone else does. And it looks pretty healthy. Also, I think from an investor standpoint, not cutting rates means there's dry powder available to cut rates later in the year if they do see a slowdown.
Okay, so let's move on a little bit. We're talking about a different sector now, and that's the software sector. And you were saying the software sell-off is overdue, and there's still some opportunities. Overdone, sorry.
Exactly. And one of the things, one of the reasons for this is fears of AI cutting into software sales and companies being able to do more. But there are a couple of phenomenal opportunities in the large cap sector. One of them is Adobe. And Adobe is a company that's been continuing to deliver double-digit revenue growth, double-digit earnings growth, big free cash flow generator. They are embedded in every major company's way of doing business on the IT side, and AI is helping them. Yet this company is trading at a paltry 13 times earnings.
Wow.
And is worth at least 50% more in our view, and we're forecasting continued earnings growth going forward this year.
Another one you're watching, Microsoft.
Microsoft, and we own both of these companies, let me say, and investors have an opportunity with Microsoft to buy one of the world's great businesses when it is on sale. Microsoft had blowout earnings of 15% plus revenue growth, 15% plus bottom line growth. And they are rolling out AI in a huge way. And Microsoft is at the nexus. Every major business in the world, Microsoft is their major IT vendor, and they are fully embedded in every company's IT infrastructure. And that should increase as more and more companies want to have one major company driving, one major vendor, because it makes it much easier for them. And so, investors have a chance on this pullback to buy Microsoft at about 30 times earnings, and we think the stock is worth significantly more.
It's interesting, right? When you're trying to navigate this whole AI world that we're moving into, the software sector, either people are very positive on it, like you, or saying, it's time to move on from the software sector. It's so hard to know which way to go.
It is, and so our focus is really on those companies that are must-haves if you're a large corporation. These are vendors you have to stick with, and you need an integrated solution. So we are less bullish on some of the smaller niche players who might end up losing market share, losing business, and actually we expect Microsoft to gain market share from some of those smaller players that don't have the scale.
Just in our last minute or so, I did want to get to the price of gold and silver today as well, because it's so interesting what we're seeing, right? Do you think what we're seeing in this kind of drop in prices, is that a delayed response from the rate cuts that we saw earlier this week, or what do you think is going on there?
So one of these interesting, little facts that I've picked up on from the World Gold Council, which is not really surprising, is that a ton of money, almost $90 billion, came into inflows into gold ETFs in 2025, up wildly from a few $billion the previous year. And gold inflow and outflows into ETFs is really just momentum-based investors, driving things, overshooting on the upside or overshooting on the downside. So our view is that investors who have significant positions in gold should be paring those positions back at least. And there are better opportunities in so many other great businesses. So we're not bullish on gold from here.
Not bullish on gold. Okay. Thank you so much for coming in. That's all the time we have. Lorne Steinberg, appreciate your time. Thank you.
Thank you very much, Lindsay.
Thanks.